So I'm actually going to go through, Dale Johnson is helped put these slides together. We work together. He's the farm management specialist for the state. And we created this farm business planning workbook a number of years ago to help people sort of guide them through a business planning process, to get loans, to create goals, to put things together. Oftentimes it is required to have a farm business plan. And we wanted to be able to give people some tools and resources to be able to create those. So the first page, and Dale has the quiz at the beginning, we're going to go through and be able to answer some of these questions. And all of these are very purposeful questions because they're going to be important when you're making decisions on how to create your financial statements and how to put together your records and your tax records. So very, very important things as you're creating your financial statement. So 2 methods of valuing assets on the balance sheet include cash method or the accrual method. So you've probably heard those 2 things, and we're going to talk about it later. That is false. All right. And we'll talk about what those are in a little bit. The next part is when you're going to be creating your balance sheet, which is super important if you're going to go get a loan and put that together, a loan package together. If you're going to do a line of credit or anything, having a balance sheet that's up to date is really important. So this question is about breeding livestock. Are they used in the ongoing production of the farm? Are intermediate liabilities? All right. And that's false. So we're going to talk a little bit about what goes on the balance sheet and where they go on the balance sheet. The next question is about borrowing $20,000 to purchase a tractor for the business. Will that decrease your owner's equity? All right, we're going to find out in a little bit about what owner's equity is. That's false. If your total asset values increase for any reason, then your net worth will also increase. All right? If your asset values increase for any reason, I think that's the key there, then your net worth will also increase. And we're going to talk about what your net worth is and which financial statement shows that. All right, 5th question. Cash flow, very important for farms, right? The cash flow budget shows the same information as the income statement, but it's broken down by quarter or month. All right, that one's false. Are you seeing a trend here with his answers? I noticed that. All right, number 6. A positive cash flow indicates that your business is profitable. Does it mean your business is profitable if you have a positive cash flow? Not really, not really. Cash flow does not give a true picture of profitability. All right, the 7th question is your net worth or equity cannot be less than 0. Unfortunately, this one is false. All right. We're going to talk some towards the end about depreciation. Very important when you're buying equipment and using equipment. Depreciation is included in the cash income statement, the accrual income statement, and the cash flow budget. Can you take a guess? False. All right. Money received from a loan is considered a form of income and must be included in the income statement. So is a loan income? No. All right, so that one's false. Okay. A farmer should be the chief financial officer of the business. That one is true, okay? Very true. Farmers should be the chief financial officer of the business. And when you think about it and you look at large businesses, and we've talked about this time after time, farmers, small businesses, they have to kind of be everything, right? They're dealing with the labor, the marketing, the record keeping, the finances, all of those type of things that a large business might have multiple positions in. So in a large business, the chief financial officer provides economic and financial information, The CEO or Chief Executive Officer and many other managers will help manage that business. A farm or small business owner, they have to be both the CEO and the CFO. And I've actually heard more than one farmer or farm wife or farm partner say they're the CEO of the farm, and I kind of like that. Okay, so you guys saw the puzzle as we were going through, and you saw those words on the puzzle. Well, here's how we sort of break it down, and these are the things that we're going to be talking about through my sessions. The balance sheet, the income statement, the cash flow. Okay, those are the three financial statements for farm businesses when we talk about farm businesses. Enterprise budgets is going to be something that we talk about towards the end, but they're almost something you may want to do in the beginning. And an example of the enterprise budget, it would be what are the costs per acre or per bushel or per square foot of a particular crop or product or animal. And the reason why it's really important to have these enterprise budgets together is, how do you know how much fertilizer is going to go on your cash flow without figuring out what is in your enterprise budget? Additionally, we'll talk some about some record keeping ideas and then that household budget. So I think that I like this recommendation, and I think that it's something that you want to write down on your calendar to do. I know people that are doing marketing and social media, they have to put it on their calendar to accomplish it. For your finances, 1 to 2 days during the winter season in financial planning, 1 to 2 hours per week through the production season in record keeping and monitoring. All right, it's going to fluctuate some, but really try to block off time. You know, it's easy to say, I'll do that tomorrow, I'll look at that tomorrow, I'll open that tomorrow. But schedule time. You know, are you a morning person? Would you rather sit down at 7:30 with your coffee and get this done, or is it more something that you would do in the evening? But try to schedule the time for your financial planning and your record keeping. Okay, so we're going to show some examples here, and this is our sample farm. We've got 25 acres of land. We have a small home and outbuildings on 1 of the acres, fruit and vegetables on 6, beef and poultry on 18. We have a 100-member CSA. We go to 2 farmers markets, and we also have some people come to the farm for sales. And this is important because we will be showing some examples of what these financial statements might look like for the different farms. And then additionally, I did want to recognize in this, you saw where the arrows go. I think this is the bottom of the quiz. If you want to draw, I think there's a box at the bottom on that one pager where you are writing true and false. You may want to be able to go to these different things when a bank maybe talks about solvency or profitability. Cash flow shows liquidity. That means we can get cash. We need to be able to get cash. And then the enterprise shows efficiency. And you'll see these puzzles go together. Again, a lot of these work very interconnected. You may start working on your balance sheet, but you've got to go to a different statement to get another number, okay? You may need to go to the enterprise budget to get what your input costs are. So they really, while they're pieces of a puzzle, they work very much together. All right, so let's talk about the balance sheet. And this is generally the first financial statement we talk about because it's the most logical. It's something that you can sit down and probably complete this evening, maybe tomorrow, if you need to look up some accounts. Has anyone done their balance sheet? Put together their balance sheet, okay. Do you do it for fun or do you do it when the bank asks? A little bit of both. So,
I did it when the bank actually helped me put it together.
Yes, absolutely, absolutely. So if you do a line of credit, if you do a loan, the first thing they're going to want to know is, what are your assets? What do you own and what do you owe? So that is really the important part of the balance sheet, is they can figure out what your net worth is.
Mm-hmm.
We get that question a lot. So the question is,
Because the bank seemed like it wasn't.
there's no line. Yes, so when the bank lends you money, when your lender, and really, the record keeping that you might keep, you're going to keep it for tax purposes, but then you're also going to keep it for decision-making purposes. But when the bank looks at it, they're going to want everything lumped together. All of your vehicles, your credit card loans, or your credit card expenses or debt liabilities, all of those get lumped into one when the bank is making that decision. And I will tell you that over the years, it really is nice to try to do a new balance sheet every. It's a snapshot, so you put the date on it, and I save the new date, and I do like to go back and compare them. So I have a line of credit that I use for our small farm enterprise, and it is nice to go back year after year and see where things, well, this year we bought a car, but we were able to pay something else off. So we got the asset, but we also had the liability. But yes, when you're working directly with the bank, they're going to want to see everything. So the balance sheet shows the net worth. So you can see here the assets you own, the liabilities you owe, and that gives you your owner's equity once you do that calculation. And it's definitely a scale. It's a detailed listing of the assets and liabilities, and it's on a given date. So again, I often will save them by the date that they're done, and I try to do them within a month every year. My line of credit renews in the spring, so every spring I sit down, I redo it, I send it to the bank, and I can see how I'm building some net worth over time. All right. Mm-hmm.
Suppose you own a piece of equipment with no farm, just half of that equity would be on your balance sheet, correct?
Yes. Yes, if you're splitting equipment, yes, and they're not part of the farm operation. Yep. And you think about it, if you were going to sell it, how would the profit be split up? Right. Too. Yep. Good question. So this is an example of the balance sheet, and there's one of these examples in the book, the Farm Business Planning Workbook that you picked up. It's the document. The book there right in front of you, Lisa, Miss Joseph, right? The other one. That's it. So that has some blank balance sheets in it. And what I'd like to do right now is just maybe take a little pause and maybe have you guys write down some of the things that might be in your categories. All right, so think about your farm. And you've got these examples here that are showing some things. And here's the one with the non-farm assets. So a lot of them will have something down there that has either non-farm, so that would be your household, any household things. Maybe it's a vehicle that you use that you don't use for the farm. Maybe it's other types of things that are not associated directly with the farm. You don't have to write in there if you want to write on just a separate sheet or however you want to do it. But the blank, there is a blank one in there. And then we also have that available online if you prefer to work in like Excel. I think it's on page 30 something. It should be in the financial side. 39? Mm-hmm. And sometimes the bank may want to know more. Maybe it's a percentage rate. Maybe it's what your monthly payment is, right? Because they're trying to figure out how much you can use to repay a loan. So they may want to know, well, you have this liability of a car payment. How much is it a month? And that's where you get sort of those current, like this $7,000 in mortgage, that's what's due this year. All right. Anybody putting anything on there that maybe isn't up here that you can think of, that maybe that's specific to your farm? I like a little bit more detail, so on mine, I have equipment and machinery listed out more. I like to see, I like to value each one of those separately. So, and that's where I say this kind of sheet and doing this kind of work, I had to add those things up, right? Like if I go to my bank account, I might have 2 savings and a checking account. Well, I've got to add those up to get this calculation. Same with machinery and equipment. I like to list out all of those because I may, maybe my 4-wheeler is paid off, but I'm paying on a tractor. Or an implement's paid off, but I'm paying on something else. So I like to see those even broken out more than that. Perhaps you own multiple pieces of property, okay? We've got here just one line for land and buildings and one line for mortgage. You may have other properties that you're farming that you would put on here.
On your intermediate liabilities, that would be like ground rent and stuff too.
So that would be cash flow. So this is, the balance sheet is anything that you can sell or you take a loan for. Yep. So an example would be, it's that asset side. So like you don't see utilities on here, okay? Because that's an expense. That's on a completely different statement. Things like, cell phones, utilities, if you have inventory, that would be on there if you had grain because you could sell that, right? All right. Well, what we're going to do as we move into these next slides is kind of dig into what some of these different sections are. Do you have a question?
Yes.
Mm-hmm.
And I'm still not really understanding this with the bank. So if you have, say, a off-farm income,
Mm-hmm.
that takes care of all your personal liabilities, mortgage, utility, how does that play into the business?
So you'll see when we get to the cash flow, we have a place to put on-farm and then a household, like a owner's draw or, a withdrawal. That would be a household expense. And what we encourage people to do when they're doing their cash flow, so different than this statement, for their cash flow statement, what we recommend people do is, have a income that is the off-farm income, and then have a household number. What does the household need monthly? Is it, does that include mortgage, utilities, electric, gas, cable, any of those type of things, groceries, all of that would be in that household budget. And we really encourage people, again, it's kind of like, where do you start talking about financial planning? And sometimes people do start with the household budget, is getting those household and personal finances in order. Because you're right, when the bank looks at it, it's everything. It is everything. So with this sheet, this is just things that you, your net worth, what you own that you can sell. That's what these numbers go in here. So like for non-farm assets, maybe it's your gun collection. Maybe it's anything that you have. Sometimes, like for my balance sheet, I have my household items. I have some things in my household items that I could sell. So they're in my non-farm assets. And again, it might be something listed out where, sometimes the asset and liability works together, right? Like a car that you own the car, but you have a payment on it. And then other times you just have either that asset. Okay. All right, so let's dig a little bit more into some of these terms, because I think this helps kind of understand more about this balance sheet and what it really shows someone. And you know, when we say the snapshot in time, right? So, you know, I just broke down and bought a new car. So next month, my asset goes down, right? Because I've made a payment. So my liability goes down because I've made that payment. Same with my mortgage, right? It's a little bit less next month. It's a little bit next the following month. So you want to think about it in that way. Value in assets can be somewhat easy. You can call up your creditors. You can open up all your online statements. What is your, as of that date, what is your balance? Okay? It's going to change next month, right, if you make a payment. But what is the balance today? Valuing the assets, and you were talking about land or you know, if you've had appraisals done, if you have some of those numbers you can go off of, there's two approaches. One is the cost approach, and the other is the market approach. The cost approach would be the cost plus any improvements minus depreciation. So it would be what was the cost of it, what did you improve, and then take away that depreciation. Depreciation is sometimes a little bit hard to value. And I would say most farms use this market of value approach. What could you go out on the open market and sell that equipment for, vehicle for, cow for, any of those type of things. So in that competitive market of informed buyers and sellers, what is that price that you can get for those assets? So I think sometimes the assets are a little bit harder to value. So let's talk about the cost approach. And again, some people like to use this one. I would try to pick one and not try to use a mix of both when I was creating my balance sheet. But this is a method of charging depreciation so your owner's equity is not affected by the asset's market fluctuations. So it's just looking at, you've got to account for the wear and tear on that vehicle, and that is what depreciation does. In value in crops and livestock, sometimes it's difficult to determine the cost of inputs used to produce them. Consequently, the market value is used. So, what could you take them for the sale? What is the market price for that? Breeding stock, machinery, land improvements, that's usually taken directly from like an accounting system or your income tax records. You've got the values of those on your income tax. And then for real estate, land is not depreciated, so only the buildings and improvements are. So again, cost approach could be valuable in some areas, but I think the market approach is a little bit more popular. This uses well-established markets when determining your asset values. The one thing you definitely have to do is be realistic in your price expectations. So I was talking about the non-farm assets. I collect Longaberger. Do I think my Longaberger is probably a little more valuable than what it might be on eBay? Maybe. Same with any of those things that you have. So be realistic in your price expectations. The old pickup probably, if you're looking out on market, just be realistic with that. Value your current assets to be sold the coming year, such as your crops, market livestock, using current prices minus your marketing costs. And that's something maybe people don't think of. If you take something to an auction, you have a percentage, right, that you have to give. Running an ad, any of that, there's some marketing costs involved. For valuing machinery, there's the book values that you can look at. Think about things that are obsolete. Is there a factor when putting the market value on machinery and buildings? Right now it's the 2021 model, right? Not the 2019 models. So think about that. And you can compare the value of a farm to other nearby farms that have recently sold. Or if you have an appraisal or something like that, you can put the value together. That's what most banks and lenders will do, is do some type of an appraisal. And when you're looking at intermediate and long-term assets, subtract the selling costs, such as those associated with selling real estate. So, and that's probably something people don't always do, is pull out those like commissions. All right, so I said there's two systems in valuing your assets. Well, there's two systems in how you group them. And the example I showed had three, current, intermediate, and long-term, or you can just do current and non-current. So let's talk about what those are. In the two system, you have your current assets, and those are easily converted to cash, or assets that are normally converted to cash during the production period, right? So it's the sale of your crops. It's the cash you have in your bank. It's your livestock that you're going to be selling. All of those are in there. Your non-current assets are ones that are not easily converted to cash, and they're not normally converted in that production period, so kind of on that annual basis. So usually current would be kind of less than a year, and non-current would be more than a year. And same goes with the current liabilities and the non-current, is how you want to group those. And that's just really important to show the lenders and group them that way so they can see, how fast could you access cash if you needed to. All right, it's a little bit easier to go in maybe to a savings account or your credit card than maybe selling a piece of machinery or a piece of property. And then there's the three category system, so current assets. So they break them into current, intermediate, and long-term. So again, and I kind of like this because it looks like that usable life, and you can sort of divide out, it helps you make some decisions on depreciation. So I kind of like this method. You've got your current, again, what you can convert to cash quickly. Intermediate, the 2 to 10 years. That's usually your breeding livestock, your machinery, things that you're going to have longer. And then your long-term assets would be, most of the time it's land, more than 10 years. And it would be the same thing with your liabilities. So, generally your machinery is kind of that 2 to 10 type loans, right? And your mortgage would be more the long-term liability. All right, so this is, all right. Okay, so this is the measurements of long-term financial security. And again, this is what the bank is going to do. When you hand them that balance sheet, and they're going to go through and say, are these realistic prices? Where are they basing some of these prices on? Have you had a recent appraisal? Did you go to Kelley Blue Book? Is there some type of basis on where you have valued your assets? And they're going to do this, they're going to take your net worth, and they're going to look at your debt to asset ratio. And the idea is that this is your repayment schedule. Do you have enough net worth to be financially secure and to be able to sustain a loan? So if it's more than 0.4, you're kind of safe, all right? They say this is, they have some good repayment capacity, they'll be able to pay back this loan. If you're in the yellow, it might be caution, and then the debt to asset ratio is red and danger, and this is somebody maybe that has too high of liabilities, right? They've got maybe high credit card debt, maybe it's new machinery that's the issue right now, maybe it's some other types of liabilities that are really increasing it. All right, so when they do that math, that's sort of what all banks have, some type of ratio. Most of the time it's within these parameters here. Are there any questions about that? Okay. So diagnosing problems and comparing assets and debts in each category. So again, in this example, again, we have a green is safe, yellow, and then red. So those numbers are only as good as your balance sheet is, but it really will help you look at your net worth and to really step back and say, okay, how do I get my assets higher, right? We had the scale like this. We really don't want it like this, right? We want it like assets here, liabilities down here. So being able to put these ratios and look at your liquidity is important. All right, so we're back at, this is what the balance sheet looked like. Does it make a little bit more sense now with the way that you put some numbers on this? Again, I would encourage you to list out your machinery and equipment, put the values on it. If you've got loans maybe associated with one tractor or implement, list out if you've got different properties. And then you can see here the debt to asset ratio and then the current ratio. So are we going to loan to this person? Yeah. All right. It's greater than that 0.4, right? So their debt to asset ratio looks pretty good from a bank's perspective. All right. Well, I'm moving away from balance sheet. We've gone through the whole balance sheet. Does anybody have any questions on it? Think they can create one pretty good? All right. And this is a perfect time of year to be talking about finances and record keeping, and try to make some maybe New Year's resolutions on putting together some financial statements and doing regular monitoring and record keeping. So we're going to calendar when we're going to work on our finances, take a look at it, step back, and make some decisions. Okay. So balance sheet, solvency, right? That gives us our net worth. That's the first thing the bank wants to see. How many assets does this person have? What are their liabilities? The next we're going to talk about is the income statement, all right? And that is your true showing of profitability. And that's where you get in some of those, the sales of things and your expenses of things. So really the profitability gives you, it's also called a P&L, profit and loss statement. All right, so income, sales of products, expenses, costs of producing, plus or minus inventory adjustments. All right, so that might be carried over from one year to another. Minus the depreciation gives you your true profit. All right, and this is what a statement like that might look like. All right. We have these nice columns again where we've categorized them. Income on one side, expenses on the other. All right, so we've got our CSA subscriptions, we've got our sales, and then we have our cash farm expenses. Now, again, how do we know how much feed costs? All right, we've got to have records. This is one of the most important things when you start putting these together. And this looks really nice to put 4,455 right there, doesn't it? But do you know how many receipts that was over the year? Right? Or how many? So you've got to have a good record keeping system, or putting this together just doesn't even work. You've got to be able to say, and I like to have, especially like a cash flow statement, I like to have what I'm projecting. Okay, this is what I think I'm going to spend on feed this year, right? This year, we went out and bought hay. Hay was a lot more this year. I paid $2 more a bale than what I have in the past. So I had to project, you know, what did I use last year? I'm going to make a good guess, so I'm going to project. And then I'm going to come back and I'm going to assess, you know, did I meet it? Did I get close? And if you do that year after year, you'll get better and better at making those projections to be able to plan. And those projections are helpful because then I can make decisions. Well, let's see, if I'm not going to buy this much hay, maybe I'm going to put an improvement in. Maybe I'm going to buy some sand or get some bluestone to come in. You know, you can make those decisions because all of a sudden you've got those numbers right there. So again, having the records so you know what these costs are just really important. And it's really easy for me to say, like, here's this one blank, just fill it out. But the amount of time it goes back to look and see, you know, how much repairs and maintenance did I do? How many times did we get the oil change? How many parts did we have to get? You've got to have some way of going back and doing that. All right, so income, expense. Down here is your inventory change. So when they talk about true profit, and this income statement is your profitability side, even though you haven't sold a crop or you still have inventory, it's got value, right? You've produced it, you've spent the money to produce it, so it's in that inventory sitting there waiting to be sold. So down here you can see it takes an inventory, your inventory change, and then you can do your profit. It's got a depreciation, and then you can figure out your profit and loss. Depreciation, you can create that. You really can look at it two ways, and we'll talk some about that in the future. There's depreciation that you do on your taxes based on what your tax situation is. There's also depreciation that you do thinking about a piece of equipment or a piece of land, and you can value that depreciation. So, and you can value that over time. So say I have a tractor and I'm going to use it for 10 years. I can use that cost of it, I can divide it by 10 years and use that as the cost of it. Now, for tax purposes, that may not be what I do, right? Because there may be some other tax law differences that I can benefit from. All right, so we've got, I think it says it on here, no, maybe not. So we've got total cash farm income minus expense gives us the 29,778. All right, then we're going to add in the 5, okay, and then we're going to subtract out the depreciation. So then we have the 25,000. So that shows us what our profitability is. I think dealing with inventory, if you carry things over year after year, so think about beef sales, right? I've got cuts of meat sitting in a freezer. I've paid to raise the cows, I've paid the processor, and it's sitting in the freezer. That's important to know, right? Because I've got that inventory. So that's why this statement is important, because yeah, I haven't sold it yet, but it's still an asset to me. It's still there. All right. Something like grain, if you don't have storage and you're growing in the spring, selling in the fall, that's not, you're doing your sales. You're doing that all in that production year. If you're, say, you have storage, on-farm storage, those bushels in the tank are a value and they're an inventory. So that really shows your true profitability. And that's the easiest way I can explain working with inventory on the income statement. All right, so this is one of the things that I tell people to put out there as soon as they start thinking about their farm enterprise is print off the Schedule F. There's descriptions in here about each of these categories, and there's a insanely long publication from the IRS, but it does have some good information in it. I probably wouldn't read it word for word, but if there were sections that I had questions about, I would look that up. It's published every year, and the first couple pages show the tax code changes. So if I'm going to start record keeping, and you're going to hear me talk about this when we talk about record keeping, you want to group things within your Schedule F, right? You want to find, and that's why like your balance sheet says, vehicles, and you lump everything together, is because these are all in one box. So again, you've got to do some record keeping on your end to pull all those receipts and information together. So I love this statement. It's something that I give to people when they start talking about finances, because you need to group your finances as the IRS would group them. So when I buy fertilizer, I know where it goes, right? If I buy a part, I know where it goes. All right, so let's talk about this part 1. And you see this cash and accrual. I think that was one of the quiz questions. All right. The cash method is widely used by farmers and small businesses. The IRS still lets farmers use that. And it is really your checkbook. Your income and expenses are recorded when the deposits or withdrawals are made. So I think of the cash method as how we work with our personal checkbooks, right? A direct deposit happens, or I get a check, I put it in the bank, I've got it. It gives you some flexibility in tax management. It may distort your actual profit or loss, and it's pretty simple and easy to use. The accrual method matches your income and expenses with the production period in which the products are. This gives you a little bit more accurate picture of profit and loss. It can be more difficult to use because you don't see it in the bank. So if I sell something in accrual, I would put it in the books before I receive the check. I would say, you know, I am owed this, right? It's accounts payable. So-and-so owes me this, I put it in the books, as opposed to the cash method where I wait till it's deposited and then it's in the books. So those are kind of the two different methods. We are going to go through just a little bit to show how it's different. And you can see for the 2 years, we still made $30,000, but it's all in when it's recorded. It is really what the difference is. So in the cash method, you produce crops and you got $10,000. You stored them, sold another $10,000. The crops produced in 2021, you had $20,000. Your inputs are the same, but again, your profitability is very different, right? Whereas in the accrual method, the crops produced, even though they're storage, you would record all of that value there. And then in 2021, your crops produced would be the full 20,000. So you're still kind of getting to the same, but it doesn't give you that true picture on an annual basis. And again, so cash method is what most farms use. All right, and this is just another example of when you would record. This is for an expense. So that was for accounts receivable, right? I'm getting paid. This is for accounts payable. People need to pay me. And so when the crops are sold, inputs purchased. And so again, it's the same bottom line when you tally up the years, but it's the way it's recorded. All right. And then this just shows in a cash system how you might change inventory. Okay, so here you've got the 30,000 total cash income. You have your ending inventory plus that, and then you would get your adjusted income. So you know how on your taxes you have your adjusted gross income? So it's going to adjust for certain things, and that is how an income statement would adjust and show your true profitability. So again, if you've got crops that lean over, if you're carrying a lot of inventory, you can imagine for somebody like Walmart, it's really important to do something like this because think about their inventory on an annual basis and what they have. Farms, we don't hold our crops that long. You know, hopefully they're coming in and you're selling them. So let's look at this. So you can get the beginning and ending inventories from the beginning and the ending of your balance sheet. So I use meat sales as an example. So if I've got beef in the freezer, that would be a current asset, right? That would be a current asset. But my beef sales wouldn't go on there, wouldn't go on the balance sheet because, well, hopefully they'd be in the checking account because I would have sold them. But the beef sales would be somewhere else. And you can see on here expenses like taxes, that isn't on a balance sheet. I mean, it is an expense that you have, but it's not a liability. Same with labor, utilities, marketing, all of those. Okay, so we've got some long narratives here that we're going to go through, and it just talks a little bit, each one of these talk about the different areas. So depreciation, we've talked some about this. You know, it is important to depreciate the equipment that you have, the cost that you have. You can prorate them over the useful life. So we were talking about, say, you know, if I'm gonna have a tractor for 10 years, I can divide it. You know, what's the cost of tractor divided by 10, and then I get a yearly charge for what that tractor might cost. Again, that may not be what you want to do for your tax purposes, but if you're really looking at true profitability, that's how you would do it. Some farmers disregard depreciation in calculating profits since it's a non-cash cost, but it really does overstate your profit if you've got a lot of equipment. And the profit looks good until you have to replace a worn out tractor or building. So if you're really using these to make decisions and you're going, oh yeah, you know, I've got plenty of, you know, I look at my profit loss, but you get ready to go purchase one, you may realize the profit isn't as good as it looks. So at least keep that in consideration when you're doing it. Deducting depreciation each year helps you calculate your true profit. All right. So setting some profit goals, and that's one of the things that we work with people, you know, that's one of the ways that I kind of start the conversation. How much do you want to make? I mean, how much do you need to make, right? To cover the household, to cover your mortgage, to cover all of those things. How much do you need to make? You know, we focus a lot on production and marketing, and at the end of the season, we hope there's profit at the end, right? So try setting some profit goals along the way, and focus on all three throughout the production season. And again, think about how much profit you want to make. Every farm business is very different. All right, so let's go through these and then maybe we'll take a little bit of a break. So improving farm profits, generating these should influence most of the decisions you make. Many things affect the level of profit, all right? So let's go through a few of these types of questions, and you know, be real with yourself when you're looking at these. Are the crop and livestock enterprises I have the most profitable use for my land, buildings, and equipment? All right. Am I using the most efficient amount of inputs like seed, fertilizer, and pesticides? Do I base the amount used on good information like soil test or pest scouting? Is my farm equipment the proper size for my farm? Do I acquire the most favorable terms on borrowed money? All right, so what would that be? Interest, time, you know, the amount of time for payback? Does my borrowed money earn a rate of return greater than the interest I pay? All right, so that means if I'm spending money, I need to be able to at least pay back that interest, right? Are my field operations timely? How can I plan ahead to prevent crunch times that cause delays in planting, weed control, and harvesting? Do I plan and carry out good marketing strategies? Do I make good use of my time and hired labor? Do I take advantage of new technologies? Are there custom field work or off-farm employment opportunities that I could augment income? Do I maintain good business relations with others? Do I manage my taxes to increase after-tax income? Are my labor costs for both myself and hired labor reasonable? And am I allowing my farm operation to grow by putting back some of my profits into the business? All right. So some big questions there, right? Which one's the hardest for you? Which one of these? Is there one that's just, I don't know?
I think a new one should be put up there for, you know, basically, how am I going to profit at all if I'm undergoing a natural disaster?
I know.
Like COVID?
This has just been crazy.
Right.
It's been all over the place for sure. How do we manage the farm in a pandemic?
Right. Ongoing pandemic.
Mm-hmm. Mm-hmm. It is, and it really has affected, it's affected everyone, and then it's also affected so many sectors very differently, very differently. How about, which one's the tough one for you guys, do you think?
I think
The last one?
because given our current situation, we're putting most of our profit
Back into the business. Yep.
I'd like to say that from a small beginner farmer perspective, a farmer once told me for the first 3 years you're not gonna even make profit. All you're gonna be doing is simply, I have to buy, how am I gonna buy it? I don't have the money to buy the equipment, I can't rent. So for the first 3 years I guess I'll have to change this up for me, but for a small business, it's not about cattle and feed, it's just about maybe like seed,
Mm-hmm.
and labor to harvest, things like that.
Labor is huge, and I think that's something that we very much underestimate when we put our numbers together is, the value of our time and what we're spending. And I would agree, most farms, you've got your investment, right? So it starts down and you hopefully start to break even. Like we did some numbers with, say, vineyards, and it was like year 12 is when you start really being able to pay back into the business, because you have investment, so much investment. Okay. All right, well, let's take a break, and then we'll talk about cash flow. Does that sound good? Okay. Yes. I think I got it the wrong way. All right, we'll go ahead and get started back. Lisa I know she has the slides. We want to go ahead and talk about cash flow. So let's do that. And you can see here, cash flow is liquidity. All right, so how liquid is your business? And if you look here, the bottom line, you've got your ending check. Really, cash flow is your checkbook. So you've got your cash income, your capital sales, and your liquidity reserve, right? And then your expenses coming out. So this is really like your checkbook. All right. So what goes into or what is the difference, right? We just talked about income and expenses. So what is the difference between cash flow and the income statement? So the income statement is your income, your expenses, that inventory we talked about, and that depreciation. When you look at cash flow, that's where money is going. That's following the money around. You generally have a beginning cash balance, and then you have your cash income, you have your cash expenses, looking at your capital sales. So that would be selling of equipment, selling livestock, anything like that. As you know, say you sold breeding stock, you sold a vehicle, you sold repairs. Maybe you do custom work. That would be a cash income line. Your capital purchases, so that would be anything that you're buying, your loan receipts, your loan principal payments, and then your non-farm receipts, your withdrawals, and then your ending balance. So that's sort of how you look at your cash flow, is everything that you're seeing hit that checking account, right? So let's go over what it looks like here. And you can see in this example, they do it by what was last year. Okay, so he's got the projected, what was actual, and then what was projected. And we talked a little bit about the importance of that, just trying to have a handle on making some of those projections so you can make decisions based on the farm. So what do you think's going to happen and what actually happened? And again, I think if that happens over time, you get better and better at making those estimates. I have seen cash flows. You can see this one is it by the quarter. I've seen them by the month. I don't think I've seen them less than a month, but I've seen cash flows be monthly. I've seen them be an annual basis, and then these are by the quarter. And then you can see the total here. This is one where we were talking about the off-farm income. So you can see non-farm income is in here. You can also see family living withdrawals that are in there. And again, I think that's very helpful when you are looking at the whole picture of being able to operate the farm and the family. All right, so what are some cash flow problems? Most farms do experience some type of cash flow problem. The budget is a great way to pinpoint problem areas or times of the year or quarters of the year where you may have some issues with cash flow. And what you can think about then, what measures could be taken to deal with the problem. And here's some possible methods for dealing with these issues. So improving profitability, cash flow problems, in solving them, you have to really look at profitability, all right? And treating cash flow problems at the expense of profitability is short-term remedies. So hopefully you've got income. We know income doesn't come in a regular basis, but expenses are going out. So really being able to manage that bottom, that income minus expenses, is very important. You want to prevent the problem, so it's important to identify them before they occur. Is there any preventative medicine you can do? Maybe there's some strategies for cash reserves. There's not one thing that will work for every farm, but maybe it's a combination of strategies that you might have. Maybe there's some production plans that you could do. Look at the enterprises on the farm. Is there a crop rotation? Is there maybe some custom services that you could offer certain times of the year that would increase your cash flow, while at the same time maintaining that profitability? And the example here is maybe spring vegetables that might generate cash flow during a time when there's a lot of crop inputs to purchase. So really looking at those production plans. And again, if you can divide it out by quarter or by year, you can really see where those things are happening. Managing expenditures is very important. That helps you. Maybe you're gonna postpone making a major purchase. Maybe it's fertilizing at the economic level instead of looking at the optimum. Maybe the best seeds or rates. There's a lot of different things that you could look at as you're looking at what your farm expense is. When is the last time you negotiated some leases or set some marketing targets? Something with livestock waste or management of compost. So maybe there's some things where you can see where money's going out and it's not coming back in, and maybe there's some efficiencies or alternate plans that you can do. Can repair bills be reduced through on-farm repairs? It's just a lot of ideas in this section to think about what your expenses are. Improving your marketing plans, so really looking at that profitability, and poor marketing is one of the main reasons for business failure, and thinking that, people are gonna buy this, people want this, and maybe they don't. Maybe they don't know how to get it. Maybe your price point is off. So improving that marketing plan. That's what I tell most of the beginning farmers is we can grow a lot of stuff here. We're in a great area to grow, but it's who's gonna buy it and are they gonna pay the price that you need to sell it for. Leasing and renting, the down payment and loan payments associated with purchasing land, lease or rental payments might be lower and might free up some cash. So just look at those. Maybe it's time to renegotiate some things. Maybe there's other terms that can be involved in some of the leases or some type of rental. Maybe it's renting equipment. Maybe, instead of the purchase of some. Reduce business withdrawals. So if you withdraw profits from the business, you might want to look at those. Is there a difference between the necessities, your needs and your wants, as far as making those withdrawals? Be realistic in the amount of personal withdrawals the farm can support. So again, that household expenses. Off-farm employment, rely more on part-time or full-time employment off the farm. Sometimes off-farm can help with health care and insurance and other things. And we know a lot of farms end up splitting those roles. One person's on the farm and maybe one person is off. Refinancing, this is one way to look at cash flow issues. Really think about the terms, but refinancing short-term loans might be a great way to solve some cash flow issues. Just looking through here to pull out some main points. Liquidating loans, refinancing, financing for a shorter period of time or a low interest rate. If you have a good handle on your cash flow, that might be helpful. It might cause some problems in the short term with having access to cash, but you're reducing that liability. And if the farm's not profitable, refinancing is a warning flag to indicate the problem is being prolonged. And I think the hardest thing about refinancing, and I would use it as a last strategy, is when you're extending the payment back out. So, you really want to think about that, because while you're extending the payment out, you're also increasing the amount of interest you end up paying. All right, what else can we do? Let's see, liquidating assets. Do you have some things that aren't being used? It's a more drastic measure with dealing with it, but there might be some excessive assets, unproductive land that, you just might want to walk away from or step down from, downsizing the operation, less capital. Don't sell assets without discussing with creditors who also have lien on those assets. So that may be an issue. And then, your credit reserve, there's borrower limits, bills can accumulate. So when you're having cash flow problems, let the creditors know ahead of time, having that conversation. And they've been dealing with that some through this pandemic. They've been dealing with it with our prices of 2019. So having that conversation, they may have some products on the market. They may have some programs that you could be involved with. So have that conversation before you get too far behind. Try to maintain your credit score with the major credit bureaus, because going back and getting loans is going to be more and more of a problem if you don't have good credit. So, try to manage your good credit score through credit management, and it will increase your borrowing capacity. All right, so we've talked about a lot of different things here. So we've got, we talked about the financial statements, right? So we've got balance sheet, which is your assets and liabilities. All right, that's what you own and what you owe. You've got your profitability, that's your income statement. So those are cash income, cash expenses, and that brings into account the inventory adjustments and the depreciation. All right, we haven't talked about the enterprise budget. That's something I'm going to go over next week. And then liquidity and cash flow. So that's your checkbook. So that's things coming in, cash income, income coming in, expenses going out, and farm receipts, principal payments, withdrawals, that type of thing. All right. So all these things work together in this really cool puzzle that are going to give you a good understanding of your farm financial condition. And it's really the foundation of your long-term success as a farm, is being able to put these different pictures. And these are very intentional statements that provide very specific pictures into your business. And I think it comes to, doing it. Become that chief financial officer that CEO, the CFO, make the time to do your financial projections, your financial planning, so you have a good snapshot of it.